Hello, and welcome to our discussion on the forthcoming changes to the accounting standard here in the UK, FRS 102. My name is Peter Manser. I'm the Audit Compliance Partner here at Creston Reeves, and I have the pleasure of chairing our discussion today. But before we get started, just a few housekeeping points to share with you. The webinar is being recorded, and it will be emailed to you on Monday. We'll have a Q&A session at the end, so please send any questions you have into the chat. At the end, there'll be a short survey, so please do spare just a couple of minutes to give us your feedback, which is so valuable to us. Now, you can ask a question by using the question functionality shown on the screen now. I'll give you a minute to familiarize yourself with how this works. Okay, so over the next hour or so, we'll be examining what these changes in accounting standards means in practice. We'll be focusing on three main key areas. Firstly, the changes to revenue. Secondly, the changes to how we account for leases. And the final area is fair value measurement. But before we start, I'd just like to take a few minutes to set the scene, to explain why these changes have come and why they're happening right now. So just to rewind a little bit, when FRS 102 was first introduced over a decade ago now, it represented a huge change, a huge step forward in bringing consistency and structure to UK GAAP, that's generally accepted accounting practice. It replaced a patchwork of old standards and simplified financial reporting for many entities, especially the small and medium-sized businesses here in the UK. But of course, financial reporting doesn't stand still. International standards, IFRS, have continued to evolve. Major developments like IFRS 15 for revenue and IFRS 16 for leases fundamentally changed the way companies around the world report key financial information. Now, these changes brought more consistency, more comparability, and ultimately better transparency for stakeholders. So the UK's Financial Reporting Council, the FRC, have been watching these developments closely. They've heard the feedback from businesses, investors, lenders, and auditors, and they recognise that while FRS 102 should remain proportionate for SMEs here in the UK, it also needs to keep pace with global standards, especially, of course, as many UK businesses are part of a larger international group. So that brings us today, a revised version of FRS 102 with significant updates to UK GAAP. Now, the FRC aimed to strike a balance, aligning with the best of what IFRS has introduced while retaining the simplicity and scalability that makes FRS 102 workable for smaller entities. Importantly, these changes are not just for the sake of alignment. They're designed to improve the quality of financial reporting, to make revenue more faithfully reflect what's been earned, to bring lease liabilities onto the balance sheet so that obligations are clearer to readers of the accounts, and to modernize how fair value is defined and then applied in financial statements. But of course, with any change comes challenge, and that's what we're here to help with today. So our panel will explore the key areas of change. They will share with us what's worked and what hasn't from the IFRS transition that's already taken place, and also offer practical advice for navigating the road to January 2026. So whether you're in finance, operations, or leadership, these changes will affect your business. The goal today is simple: to help you gain a clearer understanding of why these changes matter, where to focus your energy, and how to begin preparing effectively. So today's panel discussion, we'll look at what SMEs need to know in relation to the key changes to Financial Reporting Standard 102. With me on the panel, we have Tracy Becker, an audit partner here at Creston Reeves, Joe Timms, one of our technical directors and an audit RI, and Jack Bradley, who is a senior manager and part of the firm's technical team. In this session, we'll focus on accounting changes for revenue, leases, and fair value measurement. We'll cover what's changing, the challenges to prepare, and practical steps to get ready. We'll also tackle your questions on how these changes might affect your business. So let's begin. Joe, to start us off, could you give us a quick visual overview of the lease and revenue changes?
Thank you, Peter, and good morning, everybody. We thought it would be a good idea to start off by just giving you a visual of the lease and revenue changes before we get into a bit more detail. So on screen here, we have a very basic example of the leasing changes. So we have a 10-year lease, £50,000 rent per year, and we're going to assume an interest rate, it's going to be our discount rate of 6%. Now, currently, if you had this lease, those £50,000 would be expensed as a rental expense each year. That's a total of £500,000. What we're going to have to do going forward is calculate the net present value of those payments. The way the numbers work, that's going to come out at £368,000 on the left-hand side of the slide. That's going to be our lease liability. It's also going to be, for this example, our leased asset as well, our right of use asset. It won't always be the case. There are some other things that can alter the asset's value, but we'll keep things simple for this example. We're then going to depreciate straight line that right of use asset. That's £36,800 in this example. And in terms of the lease liability, that's going to unwind over the next 10 years. So we're going to charge our 6% interest rate to that lease liability, and then the payments that were being expensed to profit and loss, they're going to go against the liability. So as you can see, over the course of the 10 years, both the asset reduces to a nil net value and the liability comes back to zero as well. So we focus on the right-hand side of the slide now and look at the profit and loss impact. So going forward under the new lease standard, we're going to have depreciation of £36,800 per year, and our interest is going to be front loaded. So when the liability is higher, our interest is going to be higher. So as you can see, in year one, we've got £58,881 of P&L expense compared to 50 under the old model. So it takes until year 6 for that front loaded expense to unwind and actually become lower than the previous 50,000. So as you can see, changes to the asset and the liability on the balance sheet, and also an impact to profit and loss in terms of what hits your expenditure. We move on to revenue. So basically, the new section 23 is embedded around a 5-step model. So the first step is to identify the contract. Now that should be fairly simple. So a contract is an agreement between 2 or more parties that creates enforceable rights and obligations. The next step, step 2, that's slightly trickier. You've got to identify those performance obligations in the contract. So a performance obligation is a promise to transfer distinct goods or services to a customer. Next, we're going to determine the transaction price. Again, that should be relatively straightforward. So that's the amount of consideration which the company expects to be entitled to. And then we're going to allocate the transaction price to the performance obligations that were identified in step 2. Now, each performance obligation identified in the contract is allocated a relative standalone selling price. So that's going to be quite important. We'll see that in an example in a minute. And then revenue is going to be recognized when the entity satisfies those performances. Basically, that's going to be when the customer obtains control. So revenue could be recognized either over time or at a point in time. I've got a very basic example that sets this out from the telecommunications industry. So in this example, my phone sells mobile phones and airtime plans to its customers. So we're all used to seeing this. We've probably got one ourselves. So the customer can subscribe to a 24-month airtime plan and they receive a free phone for a total price of £960. Now, we all know we're not actually getting a free phone. We're paying for that within that cost. But historically, my phone would have recognised that £40,000 straight line over those 24 months. But now they've got a change. They've identified that there are 2 performance obligations in this contract: the supply of the phone and the provision of the airtime. So we've got in the column here, we're going to allocate a standalone selling price to each of those performance obligations. So we know the phone has got a recommended retail price of £600. You could walk into the shop and just buy the phone for that amount of money. And we know that the actual airtime has got a recommended retail price of £960, a total contract price of £1,560. And the way those percentages work there, 38.5% and 61.5%. So what we need to do is allocate those relative standalone selling price to our contract value of £960. So as you can see, for this example here, we've got quite a big change in how revenue is going to be recognised. We've now got to recognise £370 up front when we supply the phone to the customer, and then rather than £40 a month, that reduces to £24.58 per month in terms of the ongoing services. So quite a big change, and this is just one contract. If you had several or hundreds of these, obviously that's going to make a big impact to your numbers. If we just move on to the next slide. Alongside this, I thought it'd be a good idea just to highlight this change. The government have increased size thresholds for accounting periods beginning on or after 6th of April. So the reason, as you can see from the last few slides, the reason this is quite important is because audit has been aligned with size for a number of years now. And in the middle there, particularly important column, the small column, basically all of these limits have increased by 50% from where they were previously. So if you breach two of these three limits, the small one in particular, you fall into audit. So with the leases coming on balance sheet, those are the right of use assets, and with the revenue changes we've just seen, they could impact those two turnover and balance sheet numbers. So this is fairly important just to take into consideration the changes alongside these new audit limits. Thank you, Peter.
Well, thank you, Joe. Thank you for illustrating those points as well. But can you just shed more light on why the FRC are making these changes? What are they trying to achieve? It's not just to make our lives harder, is it, Joe?
It might feel that way during implementation. As you mentioned, Peter, there are good reasons for the changes. Primarily, they align UK GAAP to IFRS accounting. So the FRC want the same benefits for UK GAAP reporters as were seen under recent IFRS changes. So under current FRS 102, revenue recognition was quite general and can be interpreted in different ways. IFRS 15's framework is more robust and reduces diversity by giving a clear method. Similarly, bringing leases on balance sheet ends the old distortion where you had two companies with identical lease payments, one calling it debt, a finance lease, and one keeping it off books, an operating lease. Now everyone will show these lease obligations, which gives lenders and other users a more complete picture of the liabilities. Also, alongside that, many medium-sized entities in the UK are part of international groups that report under IFRS. So aligning FRS 102 and IFRS makes their lives easier since they can more easily align group reporting with the subsidiary accounts. The FRC has, however, included some simplifications for SMEs, such as some reliefs in applying the revenue model and some practical expedients for leases. So we've got low value and short-term lease exemptions. So it's not change for change's sake, so to speak. The changes are aimed at improving financial reporting, albeit with an upfront cost of implementation, unfortunately.
Well, thank you, Joe. That's helpful to understand the reasons behind these changes and that there is a purpose to the pain of implementation. Can I turn to Jack? Which changes to FRS 102 will be the most impactful to UK SMEs? And are there certain particular industries affected more than others?
Thanks, Peter. As has already been mentioned, the two headline changes are to revenue and to leases, but the extent to which your business is affected will depend on the nature of the business, how you contract with your customers, and how your business is financed. What we can definitely say is that all entities applying FRS 102 are likely to be affected by the changes in some way. It would be a mistake to play down the potential significance of the changes or to assume that you're not going to be affected at all. The changes to lease accounting will particularly impact entities in asset-intensive sectors, which traditionally employ leasing as a key financing strategy. So for example, retailers, hospitality businesses, and transport and logistics companies. But it isn't only entities in those sectors who are going to be impacted. For example, we could think about service businesses that might lease their offices or equipment. The changes to revenue can be tricky to understand without properly examining the contracts in place with customers. What you might initially assume to be a straightforward contract might not be when you look at the accounting terms. For example, if your product offerings include installation services, customer support, extended product warranties, rights to future purchase discounts, so think loyalty schemes, product customizations or training packages. If you have any of those items, you'll likely need to account for those as separate performance obligations under the revised standard, splitting the revenue by timing and the value for each.
Now, Jack, you've been doing some research into how the equivalent changes made to IFRS impacted their financial statements at the time of their transition. And this is really fascinating. Can you share some findings with us? And do you think we'll see the same level of impact following the changes to FRS 102?
Yeah, sure. So as you say, we're in the fortunate position of seeing exactly how these changes have played out for entities applying the equivalent IFRS standards for the first time. So if we start with the revenue changes, which were IFRS 15, the research has shown that 36% of the companies applying IFRS 15 posted manual adjustments to their financial statements at transition. Software and IT entities on average posted revenues of around 7% lower in their first year of implementation. This was mainly due to the deferral of parts of revenue related to ongoing performance obligation. The market saw a similar pattern in manufacturing, with the manufacturing of larger ticket items being most affected. For example, if you look at Airbus, they posted a reduction of 13% as revenue was deferred to the delivery of planes and ongoing extended warranty obligations. However, if we look at the construction and real estate sector, they posted an average increase in revenue of 14%. This was driven by long-term project revenue, which is more comprehensively recognised over time under the new standard, resulting in a catch-up adjustment being posted for ongoing projects. Telecommunications companies, thinking about Joe's earlier example, posted similar revenues on transition. Interestingly, so this was because the companies there were proactive in restructuring their contracts, which served to shield them from the impacts. The companies were also some of the most affected by the need to update their systems and to collect appropriate data. So it's important to note that when we talk about the impact of the updated revenue standard, it isn't just the numbers that are being impacted, it's the internal systems and processes used to generate the numbers, the way the entity contracts, staffing requirements, so on. So now if we turn to the lease changes, and so that was IFRS 16, these changes were even more significant than those under IFRS 15. The retail sector average increase in both assets and liabilities was 21%. Tesco added £10 billion worth of lease liabilities to their balance sheet, increasing its reported debt by over 50% and total assets by 20%. Airlines added an average of 23% to total assets. Wizz Air, who lease all of their aircraft, showed an increase in assets of 30% and an equivalent lease liability, which, as you can imagine, completely transformed their balance sheet ratios. Travel and hospitality companies on average also saw a 20% increase in assets, and telecommunications companies saw a 7% rise. Unlike in IFRS 15, the impact of IFRS 16 on SMEs was actually more significant. Most small companies saw liabilities quadruple or worse. One particular company saw an increase in liabilities of 500% and assets of 190%. Changes in EBITDA as a percentage were also inflated in smaller entities. In the case of one outlier, the change in EBITDA was 2,000%. While most companies won't experience that extreme, changes in EBITDA were typically in the range of 5 to 15% higher, which is a significant change even at those relatively modest levels.
Well, thank you, Jack. That is indeed fascinating, and we can see that in some circumstances it can have a very material impact upon the financial statements. So Tracy, if we could turn to you. We've heard that these changes mirror those which have already been made to IFRS. So what lessons can we learn from companies who have been through IFRS 15 and 16 implementation?
Well, there definitely has been a few. If I start with IFRS 15 and revenue, one of the toughest challenges was identifying all the performance obligations within customer contracts. As Jack said, this is something which isn't always obvious, and often a single contract ends up having multiple deliverables which need to be accounted for separately. For example, companies that sell equipment with installation and post-sale support needed to determine the point of delivery for each of those items separately so that they could recognise revenue when each item had been delivered, some at a point in time, like Joe's example with the purchase of the phone, and then others over time, such as the maintenance contract. Furthermore, these companies needed to determine the value of each of these items. Identifying performance obligations involved cross-departmental collaboration with sales and legal teams to identify what had been promised to customers within the contracts. Additionally, existing systems were not set up with the data required to monitor those performance obligations, and so IT and sales teams needed to collaborate to obtain the necessary data and track it in their system. In terms of the accounting department, changes need to be made to the revenue process and controls redesigned or expanded accordingly. This then extended to disclosure within the financial statements in terms of ensuring that relevant policies explained the revenue recognition criteria. Sales and accounting staff needs to be trained on the implications of the changes to the accounting standards. We would naturally assume that training of accounting staff is needed. However, the changes to revenue standard impacted more than just the accounting teams. Sales teams needed to understand how the contracts they negotiate impact the accounting function, and any bespoke contract terms needed to be carefully considered. A final learning from the implementation of IFRS 15 is to not over-engineer the identification of performance obligations. Some companies spent ages identifying micro-performance obligations and ended up with a large number of points to track. The important piece is the timing of the performance. Although we may be able to identify 12 micro-performance obligations in a contract, if they're all delivered at the same time, they might as well be recognised as one. Again, the purpose of the exercise is to identify when revenue is earned and recognise it accordingly. If we move on to IFRS 16 and leases, the big hurdle was gathering all the lease data in one place. Some companies already use lease management software, and so they were well prepared, but in other companies struggled. Accounting under IFRS 16 requires more data pertaining to leases than the previous standard. And so for companies such as retail, which have a large portfolio of leases, it took a significant amount of time to collate the lease contracts and record this data. Some contracts were also found to include embedded leases. For example, where a logistics contract includes an embedded lease of a warehouse, companies need to think about the contracts they have with providers, which may include these embedded leases, and this may take additional time and more thought to work through. A particular prominent challenge was in determining an appropriate discount rate to use it for the leases. In many cases, this required the input of an external expert. Similar to revenue, the company systems were just not ready. A spreadsheet can handle a few leases, but once you have dozens, tracking remeasurements and new leases manually is error-prone. Again, companies who made use of lease management software fared better than those that didn't, so I would absolutely recommend using one. There are several in the market, and some of them run directly as an Excel add-in, so they're fairly simple to use. On a people level, IFRS 16 was an easier concept for non-accountants to grasp. For example, it's just putting the leases on the balance sheet. But the operations team still needed to be educated to flag any new leases or lease-like contracts to the finance team early. In the past, operations teams may have signed rental agreements without telling the accounting team until month end when an invoice would appear. That had to change because leases now needed to be accounted for from day one. Both IFRS 15 and 16 implementation were major projects. In both cases, the companies that fared best were those who started planning early and treated it as a cross-functional project, not just an accounting issue.
If I can just add to Tracy's point as well, I think SMEs might assume our contracts are simple, our leases are few, this won't be too bad. But even for a small business, you can encounter pitfalls. Think about revenue. If you're a manufacturer that also does installation or maintenance services, you're likely to have multiple element contracts too. Or if you give customers the option to buy updates or return goods, these things need careful consideration under the new model as well. For leases, even 5 property leases can be a headache if you've never extracted the terms and calculated present values. Plus, SMEs often have limited resources. The financial controller might be doing this on top of their regular job. That's why planning's so important. We've got the benefit of hindsight from the IFRS adoption. One key lesson is don't underestimate the work and start sooner rather than later. Based on where we are in the year now, this is fairly critical.
Well, thank you very much, both. That's a great lead into preparation. So we know what's coming and that it can be challenging and can involve a lot of people throughout the organisation. So what should SMEs be doing now to prepare for these changes? Particularly considering that the effective date is January 2026. Joe, would you like to start?
So yes, Peter, the clock's ticking. So the first thing I advise is perform an impact assessment. Essentially, do a dry run on a sample of your contracts. So that's both customer contracts and your lease agreements. This will highlight how revenue might shift under the new rules and how big your lease assets and liabilities might be. For revenue, pick a few complex or representative contracts and go through the 5 steps of revenue recognition. Identify the performance obligations, allocate the prices, and see if the outcome's different from your current accounting. For leases, gather all your lease commitments and calculate what the liability would be if you'd put them on the balance sheet today. This exercise can reveal which areas will have the biggest impact, maybe a particular product line or division. Next, review your contracts systematically. It might be wise to set up a small task force, include someone from finance, someone from sales, and in the unlikely event, if it is applicable, legal as well, to go through templates of your customer contracts and lease agreements. Identify any tricky terms. So, for example, do you provide warranties beyond basic assurance? That's going to be a separate performance obligation now. Do you have volume rebates or variable consideration? Those need careful estimation under the new standard. For leases, check if service contracts have an embedded lease of an asset. And importantly, this is an important one, check for any covenants or agreements that refer to your financial statements. You might need to talk to bankers or investors if those metrics are going to change. On the system side, evaluate if your accounting software can handle the changes. Some SMEs running off-the-shelf packages might find that an upgrade or module is available for the new revenue recognition. Software providers knew these rules were coming because of IFRS and often built capabilities for them. For leases, even a well-structured spreadsheet can work if you have maybe 10 leases. If you've got 50 leases with different terms, consider investing in a lease management tool. The point is to avoid manual errors and ensure you can produce the required disclosures. So this is going to be maturity analysis for lease liabilities or a breakdown of revenue by category, which are going to likely to be required. Also, build in time for parallel runs, maybe later in 2025. Try producing numbers under both old and new rules to verify your processes so that come 2026, you're not scrambling. To facilitate all this, it's going to be helpful to have a project plan with milestones. For example, a target date for completing contract reviews, a target date for choosing transition options, system solution in place by X date, etc., etc. That's going to help keep you on track. and involve your accountants or auditors early on. You don't want to do all this work and then find out at year end the auditor disagrees with your approach on something that's fundamental. Maybe do a dry run presentation of what you think the impacts are and get their input. This can avoid headaches later, obviously.
I think if I can just add to what Joe said there, training and awareness is something that's often overlooked. So start educating your team now. This could mean sending your finance team to a workshop on the new standards, or even internal training if you have the knowledge. Make sure you and your teams understand key concepts like overtime versus point-in-time revenue recognition, or how to determine the lease term, including renewal options, which will require judgment under the new lease standard. Also raise awareness in other departments. The last thing you want to do is spend this year cleaning up your contracts and then the sales team goes and signs a big deal next year that bundles a bunch of performance obligations that you haven't accounted for properly. If the sales team and others know what triggers a separate piece of revenue recognition, they can at least flag it or structure deals more thoughtfully. In the same way, if the operations team is about to enter a new long-term service contract that involves using a specific asset, they should check in with the finance team first to assess whether that might be a lease.
I would also add external communication. For example, if you anticipate that adopting these standards will cut your 26 profit by, say, 5% due to the timing differences, you might want to tell your shareholders or owners in advance so they're not shocked when they see the accounts. Or if your balance sheet is going to balloon with lease liabilities, discuss this with your bank sooner rather than later, as debt covenants may need to be renegotiated. A good option is to provide stakeholders with a pro forma number showing the comparatives, which they would have been if they were prepared under the revised FRS 102 standard. This will allow for a reassessment of the real performance of the business. Also, don't forget about things like bonus schemes or dividends. If your part of your team's bonus is based on EBITDA, then EBITDA will likely improve under the new lease accounting since the rent expense is removed. You therefore might need to adjust the targets to keep the incentive fair. Or if you traditionally pay out a certain percentage of profits as dividends, be mindful that revenue deferrals could reduce profit initially, not in true terms, but in relation to accounting and the statutory accounts, and therefore could limit the distributable reserves if they're not planned for. These are discussions to have with owners or boards ahead of time.
Well, thank you. They're excellent practical points. I think we can begin to see that there's many moving parts to this exercise, aren't there? There's the contract, the systems, the people that have to be involved, the stakeholders as well. So we focused a lot on revenue and leases, but are there any other changes in FRS 102 that our audience should be aware of? Maybe not in so much detail, but a brief heads up. Jack, can you start us?
Yeah, sure. There are a few more minor ones. So I'll just run through those. So fair value, the definition in the revised standard now aligns with IFRS 13. So expect more clarity on how to measure fair value and possibly more disclosure on the assumptions that are made. If you value investment properties or financial instruments, make sure you read that new guidance. On financial instruments, we actually have some good news. And that's that they've postponed the expected credit loss model, so you don't have to do complex credit forecasts for receivables, at least not yet anyway. But if you are using full IFRS 9 by choice, then you'll have to provide some extra information on credit losses. On uncertain tax treatments, if you have any ongoing disputes or aggressive tax positions, there's now guidance similar to what's provided in IFRIC 23. Essentially, that says account for taxes as if the tax authority will examine you, unless you're absolutely sure that they won't. On business combinations, a bit more guidance has been added. For instance, identifying the acquirer. This might seem obvious, but in mergers it can sometimes be a bit tricky. And distinguishing whether earn-out payments to former owners are actually part of the purchase price or whether you're just paying them for a future service. So if you're involved in acquisitions, a heads up on that one. And then for small entity disclosures, A lot of what was previously encouraged disclosures are being made mandatory in the revised standards. So think things like dividends payments, deferred tax information, related parties, share-based payments. There's quite a bit more that goes into that now. So even if you're a small company, you might have to add quite a bit more to your notes.
I'll also add that certain sectors should take notes of some specific tweaks. For example, charity and not-for-profit entities. FRS 102 has clarified income recognition for donations and grants in the specialised activities section. This ties into the ongoing development of guidance in relation to not-for-profits. Also, agricultural businesses. So if anyone here is in the farming or timber industry, there's now clarification on how to account for biological assets like valuing livestock, or what costs can be capitalised if you're not fair valuing them.
Thank you, that's a great roundup. So to summarise then, beyond revenue and leases and fair value, we've also seen financial instruments, tax uncertainties, business combinations, as well as some specialised areas all see changes. So if there are any more questions from the audience, please send them in to us now. You'll see on screen is a reminder of how to ask the questions. But we asked for questions from participants ahead of the session, so let's turn to some of those now. Some common questions our clients have been asking us. Joe, we've had a lot of small equipment leases, coffee machines, laptops, cell phones, etc. The question is, do we have to put all these on the balance sheet?
So the standard provides a low value asset exemption. So typically items like laptops, phones, small devices qualify as low value. The IASB in their basis for conclusions put forward a suggested value of around £5,000 for or less when new. So you can elect not to capitalise those. You'd continue to expense those lease payments straight line as you are now. The key is consistency. So if you take the exemption, apply it for all low value leases. Also note, low value refers to the value when new. So if you lease a used asset cheaply, consider the asset's original value. For coffee machines, laptops, yes, most would say those are low value. So you might only capitalise the bigger stuff, property, machinery, vehicles. Another exemption is leases that are short term, so i.e. 12 months or less with no purchase option. They may be expensed too. So you have some practical relief. That said, keep an eye on quantity. If you have hundreds of low value leases, even off balance sheet, you may need good controls to track them, albeit they're not going to clutter up your balance sheet.
Thank you, Joe. Now, Tracy, a question for you on transition. So do companies have to restate their 2025 comparatives when they first apply these changes in 2026?
So if we assume a 31st of December year end, for revenue, FRS 102 will allow a choice, similar to IFRS 15. So you can either do full retrospective application, that means restating 2025 as if the new rules were in place, and this will then make 25 and 26 comparable. Or you can do a cumulative catch-up at the 1st of January 26, where you adjust opening reserves and just apply the new rules going forward. Many SMEs might opt for the latter because it's simpler, as there's no need to restate last year's numbers. If you do this, please be mindful that if there's anyone comparing your 26 and 25 figures, they have been prepared under different rules. For leases, the FRC decided on a modified retrospective approach only, so no full retrospective option for lessees. So you will not restate 2025 for leases. Instead, you'll put the assets and liabilities on the balance sheet for 26 and deal with a one-time adjustment in reserves as necessary. This means your 25 accounts will still show a rent expense and your 26 accounts will show depreciation and interest. So the year of adoption will have a comparability issue on the income statement. With this, companies should explain this in the disclosures to the accounts. There will be transition disclosures similar to when FRS 102 was first adopted, like a reconciliation from operating lease commitments under the old rules to the opening lease liabilities prepared under the new rules. These are typically required to help bridge the gap for users, so start planning to compile that information.
Excellent. Thank you very much. Joe, if I could go back to you. Can we say that these changes are just optional? Can we choose not to adopt them if we think they're not beneficial for our company?
In short, no, Peter. So once effective, they're mandatory for entities reporting under FRS 102. So this is a wholesale change to the standard. So early adoption is optional. You could adopt before 2026 if you wanted to, as long as you take all the changes together. But deferring adoption past the effective date isn't an option if you're using FRS 102. You'd be non-compliant with the standard. The only way to avoid them would be if you qualify as a micro entity, in which case you could adopt FRS 105, which hasn't changed with respect to leasing. However, the 5-step revenue model is now also embedded within FRS 105. We've actually seen the lease changes to FRS 102 push a number of entities into using FRS 105, which they previously qualified for but didn't utilise.
Oh, that's an interesting point. Thank you there, Joe. Jack, is there any help available for SMEs, such like templates or guidance for implementation?
Yeah, definitely. Take a look at what's out there at the moment. The FRC's website has a detailed basis for conclusions and some Q&As on the changes. They received a lot of feedback from the consultation process, so they're aware of all the main concerns. Also, the professional bodies like the ICAW and the ACCA have been running articles and webinars. For instance, the ACCA published a summary of the key changes. Industry groups as well might be sharing how peers are tackling it. And of course, we at Creston Reeves can provide some hands-on support, or at least a readiness assessment through our accounting and advisory teams. Given that many entities will be in the same boat, there's likely to be some community learning going on as well. So don't hesitate to reach out through your professional networks. Sometimes software vendors also provide guidance as well. So for example, if you use a particular accounting software, check their documentation or user forums. They might have updates or modules specifically for IFRS 15 or 16 equivalent features.
Thank you, Jack. Well, this has been very informative. So before we wrap up and move on to questions from the audience, a final question to each of you. If you could give one key piece of advice to an SME preparing for these FRS 102 changes, what would that key advice be? Joe?
I think mine would be start early and treat it as an opportunity to improve. So use the transition to also clean up any messy contract arrangements you might have or lease management processes in your business. Early planning will reduce the stress immensely.
I think mine would be to involve the right people across the business. Don't try and just do it in a silo. The accounting outputs might be technical, but the contracts and business practice inputs are cross-functional. So get buy-in and involvement from various departments.
And I think I'd add communicate proactively, both inside your company, so everyone knows what's coming, and outside, so stakeholders aren't surprised. No one likes surprises in the financial statements, but if you educate and set expectations, the transition will be much smoother.
Yeah, thank you very much. That's very practical advice. So thank you for those points. So let's turn to some questions from the audience then. Joe, if I could spring this one on you. For a smaller entity, would you recommend making these adjustments at a statutory level only and keeping management accounts unchanged? Certainly the lease changes will be very confusing for non-finance staff. So Joe, can you help us with that one?
That's an interesting one. So technically, these standards only apply to statutory accounts. So I guess you could leave your management accounts unchanged, but that's going to be very messy when it comes to preparing the statutory accounts at year end. I think it would be impractical to not do the revenue. If your revenue recognition is likely to change, that's just not going to be manageable. I guess if you had a very small number of leases, you could continue accounting for them in your management accounts as you are, and then change them in the statutory accounts. But there again, I think my advice would be work with your accountants to try and get your management accounts rolling so that they flow straight into the statutory accounts.
Yeah, that would seem to make sense. So thank you for that. Now we've got a question here about leases. So to Tracy, if you could answer this one for us. So under leases, what if you're the lessor? Do those have to go on the balance sheet as well?
So you'll be pleased to know that under the revised FRS 102, there is no major changes to lessors. So you would account for them as you currently have been already. So that is some good news for one side of the agreement.
Excellent. Okay. Still on leases, but Jack, perhaps you could chip in on this one then. The cost of dilapidations. So currently we don't do anything for this. What should we be doing going forward is the question. So dilapidations.
Yeah, so there's no major change here. You will continue to have to calculate your dilapidations provision if you've got that term within your leasing contract. I suppose the slight difference is that the asset, the corresponding entry to the liability you recognise will add to the right of use asset that will already be on the balance sheet.
Thank you. And now, Joe, I think this is one for you. If you remember the illustrations you kindly talked us through, you spoke about the interest rates, but how is that set? And do we have to review and change it year by year?
That's an interesting one. So no, the discount rate is set at the beginning, so that isn't generally changed. There are other scenarios where there can be lease modifications. But in general, that asset and liability are calculated on day one and not changed. Obviously, every lease has got a rate implicit within that lease, but that's not always easy to identify. So in that case, the standard says we use the company's incremental borrowing rate or its obtainable borrowing rate. Now they're set within the standard as very specific definitions. But basically, yeah, if the interest rate is hard to establish, then the standard defines what the company's incremental borrowing rate or obtainable borrowing rate is.
Okay, so I have to look at the definitions on that one.
Yeah.
So a question here on comparatives, which is a bit confusing, isn't it? So will we need to restate the 2025 comparatives to comply with the new standard for 2026 when we produce the 2026 accounts under the new standard? So what do we do with comparatives? Jack, can you answer that one for us?
If I can actually pass that one over to Tracy, who covered that briefly within her within the panel discussion. Tracy, do you want to give us a quick overview of the
Very
differences?
slick movement, Jack. Well done.
Yeah, good deflection. So as I mentioned earlier, there are two different scenarios for revenue and for leases. For revenue, going back to what I mentioned before, you can either do the full retrospective application, so as if the rules were already in place for the prior year, or you can just do a catch up to reserves and everything gets captured in the 26 figures and you don't have to restate 25. For leases, you don't have an option. You can only do the modified retrospective approach. So you leave 2025 as it is, and you would put all your assets and liabilities on the balance sheet in 26, and then the adjustment goes through reserves. This is very similar to the adjustments that were done when we changed from old UK GAAP to FRS 102. So hopefully it shouldn't be new for everyone, and the disclosures in the accounts are quite prescriptive and helpful to the readers of accounts, so that should help.
Yeah, thank you. I can see that's a question we'll be going back to near the time as well. Another question on leases. I think this one is a basic question, but really sort of gets to the nub of the question here and the scale of the problem. So the question being posed is, do the lease accounting changes apply to rent of a building? Joe, do you feel you could answer that one?
I think the simple answer to that is probably it would be unlikely that would qualify for the low value. I guess if it was less than 12 months, if there was a less than 12-month lease, that could possibly be exempt, but they're the only two real exceptions. So I would imagine to see most property leases coming on balance sheet.
Yeah,
and there's some quite prescriptive guidance in the standards around identifying the lease, which in most cases is quite obvious, but in some cases it may not be, and that's where you also see some judgments creeping into this part of the standard as well.
Yeah, excellent. Okay, we got the message there. Now, a further point then, how do you deal with a break clause in a lease agreement? So that's quite common, isn't it? You've got a lease agreement for a bit of time, but there's this breaks built in. Joe, could you field that one?
Yeah, again, another area of judgment, because the lease term's basically the non-cancelable period. And then any periods covered by an extension, if the lessee's reasonably certain to extend, you'd include them. So there again, it's fairly judgmental. In the absence of any evidence of a break or intention to break, you would include the full term of the lease.
Excellent. So we need to look at the clauses, and we need to understand the intention at the commencement of the lease.
Again, as Jack mentioned, all these areas will have an element of judgment to them generally.
Yeah. Okay. So asking a question here, asking for our view about audit and the audit regime. We spoke about the numbers changing there, didn't we, for small companies? So could these changes bring my company within the audit regime? Jack, can you give us a view on that?
Yeah, the simple answer is yes, they could do. Right of lease use assets, which may be recognised for the first time, will inflate the gross assets of a company. And this is one of the measures, along with turnover and employee numbers, that's assessed when determining a company size and therefore its requirement for audit. Any increase in reported turnover as a consequence of the revised standard will also have an impact. But don't forget that the size thresholds are also changing for accounting periods beginning on or after the 6th of April 25, as Joe mentioned right at the start. So you'll need to look at that one carefully.
Yeah, thank you very much. So it needs to be judged on a case-by-case basis, doesn't it? Now, here's a very practical question. What are the tax implications of the changes to revenue and leases? So we're looking at the tax implications that flow from these accounting changes. Joe, do you feel you could answer that one?
Yeah, so as is generally the case, tax follows accounting. So certainly for any revenue changes, that's just going to flow through into the profit or loss figures. That one's fairly straightforward. Leases, there are provisions in the tax that allow for the finance interest and the depreciation charge to be tax deductible. So that's been the case for a long time with leases. Finance leases, you generally get the depreciation as a tax deduction rather than capital allowances, etc. So the simple answer is, rather than your rental costs being tax deductible, the finance cost and the depreciation which replace it will also be tax deductible. But obviously there'll be some tax cash flows impacted there, because as we saw, there is a timing lag between what hits profit and loss.
Yeah, thank you. People will be concerned about the tax implications, won't they, clearly? Now, here's a question from someone who obviously knows the existing standard. Jack, I think this is one for you. Has section 1A of FRS 102 been changed?
Yes, it has. So while the underlying accounting is the same as the revised standard, the number of disclosures that are required has increased. So as I said earlier, some of those which were just encouraged under the previous version of the standard are now mandatory. Some of those changes are on going concern, related party transactions, dividends, leases, and share-based payments. There's quite a lot more in there that previously was excluded under section 1A. Okay,
so some changes there to be aware of as well. Now, we mentioned, didn't we, about FRS 105, the accounting standard for the smaller entities. So the question here is, when working out if my company is eligible for FRS 105, do we need to take account of right of use assets? So these are the ones that are going to go on the balance sheet. Jack, can you help us with that one?
Yeah, so interestingly, the answer here is no. So we have FRS 100, which sets out how we apply the standards, and that states that in establishing whether the eligibility criteria for FRS 105 have been met, the turnover and balance sheet total are measured in accordance with FRS 105, and that the measurement of turnover and balance sheet total in accordance with FRS 102 doesn't need to be considered. So as we heard earlier, FRS 105 simplifies the accounting requirements, particularly in terms of lease accounting. So that's a key point to understand.
Yeah, that makes sense, doesn't it? So that's a logical explanation there. Now, here's someone exercising their imagination, I think, Tracy, on leases. So supposing I've got a break clause after year 1, can I then classify that as a short-term lease?
So I think I'm actually going to go back to Joe on this one, because I think he answered this earlier. Sorry, Joe.
Sorry, what was that? What was the question, Peter?
It's about the break clause.
So supposing I've got a break clause after year 1, so very early on in the lease.
Yeah.
Can I then just say, well, that lease is just a short-term one and I don't need to count it?
There again, it's judgmental and it would come back to intention. So you couldn't restructure your leases to have, well, it would be unlikely you could restructure them with the landlord in such a way. But if they were structured in such a way that they had an annual break clause, then if you had no intention of breaking that lease, then you couldn't use that as a get out from bringing it on the balance sheet. If there was evidence that you continue to, opt not to break each year, that sounds like a little bit of a get out there.
Yeah, I think this is one which, if you are audited, then this is one to engage with your auditors on early on, because it's potentially a significant judgment when assessing the lease term and what's reasonably likely to happen. And ultimately, that's what you should be falling back to. Like, in reality, how long are you going to occupy that premises, or how long are you going to use that piece of machinery, and then work back from there. Don't be too don't be off put by what's actually within the lease contract, which for commercial reasons might be structured differently.
Yeah, back to intentions then. Another one on this exemption then. Supposing you've got a rolling monthly contract, can that exemption apply as a short-term lease? So a rolling monthly one, does that make a difference?
I think, again, it's an assessment of what the expected lease term is likely to be. So again, it was just falling back on this judgment point. You can see from we've had a few questions along that vein already. So we know that's going to be a key issue when making those assessments. I suppose the other thing I would add here is that when making those judgments and assessments, make sure you document that, write it down, so it's really clear what you've done and what your thought process is, so that you can apply that consistently to your portfolio of lease arrangements.
Yeah, thank you. Here's a nice simple one perhaps for you, Joe. So supposing under the new rules there's no changes to my financial statements, do I need to state that there are no changes in my financial statements? Do I need that disclosure, Joe?
No, not in black and white. I mean, your accounting policies should clearly set out how you're accounting for revenue and leases. And the leases one, for example, should disclose the exemptions in terms of the short-term leases and the low-value assets. But you don't need to caveat in black and white that your balance sheet or your profit and loss hasn't changed because as a result of these changes. But your accounting policies should clearly set out how you are accounting for these things. Yeah,
that completes the story, doesn't it?
Yeah.
Here's a nice question perhaps we could just end with. Clearly, we've managed to enthuse some of our audience, because the question is, can I adopt the new version of FRS 102 early? So, Jack, can someone adopt it early?
Yes, you can do, but it's important to note that you need to adopt all of the changes at the same time. This might be of interest, I suppose, if you're a UK company that forms part of a multinational group. So it could be something to explore. The revised standards bring the UK reporting more into line with IFRS and US GAAP. So once the changes have been adopted, you may then have a reduced need for complicated consolidation adjustments later down the line. The other obvious time, perhaps, when early adoption would make sense is for newly incorporated entities, so that you don't need to make transitional adjustments again in the future.
Thank you for that, yes. So we'll finish our questions there, but if you have any further questions or we haven't managed to answer yours yet, we will follow that up with you on a one-to-one basis. So I'd like to thank all our panel for their contributions. Thank you, Tracy, Joe, and Jack, particularly for your practical insights, which really fleshed the whole discussion out. And to our audience, we can see, can't we, the changes to FRS 102 are significant, but with proper preparation, your company can navigate them successfully. Remember, this does align the UK with global best practice and can make your financial reporting more robust and useful to readers of the accounts as well. So as next steps then, consider performing an initial impact assessment imminently if you haven't done so already. Sketch out a plan. Remember, there's only around 6 months to get everything in place, and reach out for help if you need it. This is not something you have to tackle alone. So we hope this discussion has clarified the what, the why, and the how of the FRS 102 changes. We'll be around for a few more minutes if there are any additional questions. If there's anything that you would like to discuss further, please reach out to us. Don't hesitate to contact us. A recording of today's webinar will be emailed to you shortly and will be available on our website as well for further viewings. So our annual Finance Focus events are taking place next month, so look out for those. More information on these, and to register your place, please use your smartphone to scan the QR codes on screen now, or you can visit our website where you'll find those details of future events. Please also do complete the very short feedback survey at the end so we can continue to improve these webinars and events for you. We do truly value your feedback and listen carefully to it. And finally, thank you for all attending. And remember, Creston Reeves is here to help your implementation efforts successfully. Thank you.